welcome to Converging Dialogues. This is Xavier Bonilla. Today I am speaking with Bruce Carruthers. Bruce is out at Northwestern University in the Department of Sociology. He has a bachelor's in communications, a master's in sociology, a PhD in sociology from the University of Chicago. He is currently the John D. MacArthur Professor of Sociology, and he has previously been the director of the Buffett Center for International Comparative Studies and the Buffett Institute for Global Studies. He's the author of numerous books, including the most recent, The Economy of Promises, Trust, Power, and Credit in America. And that's what we talk about in this conversation. As I mentioned to him in the conversation, this might not be the most eye-catching or sexy topic necessarily for folks to talk about the history of credit, how credit was built, rating score and national debt and things like that. But as we talk about in the conversation, it is obviously supremely important. It's something that we have that impacts all of us in the United States and in other places as well. But his focus is on the United States. And so it's a really important conversation, whether you're getting a car payment or a mortgage or any other type of loan or student loans or what have you. Very, very important topic. We start the conversation by talking about why his framework is that of promise and trust. He kind of takes a conceptual lens, as he mentions in the conversation. He's not an economist, he's a sociologist. And I actually think that's a really nice way to conceptualize things like credit and finances. Economics are obviously very important, but it's also good to have a kind of broader lens on some of these things. We talk about how we willingly, as citizens, go into debt to be a part of an American capital economic system, what that's about, pros and cons of that. We spend a lot of time, and a majority of the time, talking about the credit rating score, its history, how it got started, its expanding evolution. We also talk about the national bank system. We have had 3 national banks, well, 2 officially. Currently, we have the Federal Reserve, why that's important, why it's necessary. We talk a little bit about the national debt, and we talk about student loan debt. How do student loans, obviously function, where they're at, issues with it, and some of the more recent changes to student loans, such as student loan forgiveness. This is a really important conversation, I think. It's definitely, his book is such a good one because he has a nice through line where he's putting all these threads together, and it has a really nice cohesive touch to it. And so it was really, really important, I think, to talk about this stuff. I really enjoyed his book and enjoyed the conversation. So now I bring you Bruce Carruthers. I'm here with Bruce Carruthers. Bruce, thank you so much for coming on the podcast. I'm looking forward to talking to you.
My pleasure.
You have written a fascinating book, a really, really good book. Now, I'll be honest. I'll be very honest. Most people, I don't think, when they're in the bookstore, are looking for books on credit and bank lending and debt and all of these things. But I have to say, it gets talked about a lot in society, and your book was so good in terms of trying to understand the history of things. You explain things in a really tangible, easy way. And so I really enjoyed reading the book. I probably read it in a couple days, if I'm honest. It was very good. It was very informative, and so you do a nice job of putting it all in one place. So it's really fantastic in that way.
Well, thank you for those compliments, and really, it may not be the sort of thing that has a lurid cover and jumps off the bookshelf at the local bookstore, but really, we all live in a credit economy, and so explaining how a credit economy came to be, how it operates, what its foibles are, what it means, that's really the intent of the book. So I'm hoping to explain something that is a part of our daily lives and also part of lives that maybe we don't think about.
Yeah, no, you absolutely do in the book, and so I'm really excited to talk to you about some of it. Before we get into it, just tell listeners briefly who you are, what you do, what you study, your background, all those wonderful important points.
Sure. So I'm a professor of sociology at Northwestern University, and I've been at Northwestern for a good long while. I got a PhD from the University of Chicago, so I've been in the Chicago area for quite a few decades. And, there have been a couple of big events that happened in the world of credit that really caught my eye and helped me kind of decide that this was a book I wanted to write. Most recently, the global financial crisis of 2008, which some of your listeners probably are still, wincing from.
Yeah.
That was a big, shocking reminder that global finance and financial markets and financial institutions are really critical, and they are unstable. They contain lots of surprises, and we're really embroiled in them. More recently, the conversation that's followed from President Biden's, student debt proposal to, let people off the hook for a certain amount of money as a form of debt relief. It's also a reminder that, there's lots of people who feel the burden of indebtedness, who are struggling to deal with it. And government policy can make a difference, but of course, that's the controversy. There is some people think it's a good idea, and some people think it's a terrible idea. But it really provokes lots of beliefs about why one goes into debt, how much one should be obliged to repay debts, whether there's people who should be relieved of their debts. Lots of things get provoked in that. So I think there's. I got interested in this precisely because there are so many reminders of why it matters, and yet it, I think, operates kind of below the radar screen in a lot of ways. That is, we're all inserted in this world of credit, and of course, we try to manage as best we can. But there's not really. It's hard to get the big picture. It's hard to kind of figure out, what's happening more broadly, and how did the system come into being, and why does it work the way it does? So those things provoked my interest, and. Truth in advertising. I'm not an economist. I'm a sociologist interested in the economy. So I bring a different perspective, and you, I'm sure, picked up on this in the when reading the book. I bring a different perspective than what an economist would do, and that's just going to be different.
Yeah, no, I was going to mention that because I think it's actually a strength because, I've read books written by economists, and they don't make for the best writing half the time. It's a lot of charts and graphs, and it's very dry, and it feels like I'm reading a paper, and there's not a whole lot of, fluidity to it. It's good content. It's kind of like a data dump, but maybe not the best writing. And so the best thing for I think your book, and a strong selling point is there's a very nice cohesive narrative that goes throughout the book, which says, okay, here's what this is. Here's how we can conceptualize these things this way. Here's the kind of thread that runs through this. Here's why it's impactful. And so I think that, at least for me, was very nice to have that. And again, something that I would very easily recommend to someone to say, hey, if you're a little confused or wanting to understand some of these, big things we deal with on a daily basis, you should check out this. This will give you some clarity on that. So I think it's actually a strength in that way. So,
well, thank you, and that is something I tried. I worked hard on, and I think for me, one of the interesting things about all these financial relationships and activities and whatnot is precisely that they do seem to be pretty inscrutable. They seem very technical, and your eyes glaze over, and there's all these special terms. And so one of the things I've tried to do is to make it digestible and to translate it into language that people can understand. Because at bottom, I do think there are some pretty straightforward things that are in place here. And there's a lot of kind of mystification about it, and it's easy to get confused. But really, there is a story to be told, and it can be comprehended by regular folks. It's not a mystery.
Yeah. Well, and I think it has to be, right? Because financial literacy is a really important thing, I think, for all folks, and trying to understand that loan I took out, or my mortgage, or whatever it may be. I mean, this is something, again, most people are going to interact with on a daily basis.
Yep.
So your framework for the book, and kind of the main thesis, at least my takeaway, so the book is called The Economy of Promises: Trust, Power, and Credit in America. You deal with this you take the broad view of it from the beginning, and you talk about a promise, you talk about trust, you talk about interdependence, you talk about all of these types of things. And I guess I'm curious as to why you took that kind of approach, and then maybe just kind of tell us some of those things within a financial or economic context, why promise and trustworthiness and all these things are really important to understanding these big systems.
So thank you. That's a good provocation for me. So one of the things that's really interesting, I think, about how the American economy has evolved is really a transformation in what constitutes wealth. So if we think about what is the value in a society, what does wealth consist of? And if you went back, to the beginning period in American history, you see a lot of tangible wealth. People own land, people have cattle, people have farms, people have houses. It's stuff, it's literally physical stuff. And what we now operate in is a world where there's a lot of wealth, but a lot of it is intangible. It doesn't consist of things and stuff. And wealthy people have, mega mansions and nice cars. But if you look at their household balance sheet, most of their money is tied up in financial assets. Mm-hmm. And so it's really important to understand what's distinctive about finance, that it has become so important. And at the heart of a lot of finance is a thing called a promise. Mm-hmm. It's a commitment by one party to do something in the future. And in the context of credit and finance, that's typically the promise that a debtor makes. If you, Xavier, give me $1,000 today, I will repay you, $2,000 in 10 years, or some kind of promise like that. And you get to decide if that's a deal that you like. But for a time, my promise to you, it's an asset for you. You get to say, oh, I've got this $2,000 that's going to show up in 10 years because I believe Carruthers. He's made me a promise I believe. So one of the things that's really important about promises is, sometimes they are credible and sometimes they are not. And you would be a sucker to believe every promise that you've ever been made.
Sure.
So lenders are in that position of receiving promises and having to evaluate them and having to decide which of these promises do we find credible and which not. And also, basically, that means who do we trust? Do we trust someone to repay us, or do we distrust them? And so that the extension and acceptance of lots and lots of promises and the extension of lots and lots of trust is really one of the big things that's happening in a credit economy. It's one group deciding who else is trustworthy, and most of us are simultaneously knitted into this very complex network of promises on both sides, which is to say, people make promises to me, and I make promises to other people. I'm not always the promise maker. I'm not always the promise receiver. And most entities kind of operate that way. So what makes a promise problematic? Well, as I explain in the book, there's really two key elements. One is uncertainty, which is to say, a promise is basically a statement about what may happen in the future. Like, I will repay you in 10 years, $2,000. Well, the future is uncertain. We don't really know what will happen in the future. And so we want to know what's going to happen in the future because our fate depends on it. And one of the ways in which we can deal with that uncertainty is we gather lots and lots of information. So that's how we learn about the future. We learn about this individual who's made us a promise, and we kind of decide, I learn more things about this guy, Xavier, and he seems like a good guy, and I think I can trust him, so I'm going to lend him money, right? The other element is dependence, which is to say, I, as a lender, my future, my fate depends upon whether people repay the loan, right? So if I've accepted somebody's promise and they default for some reason, I'm at a loss. I lose the money, right? I now have, what I thought was a valuable promise. It turns out may be worth less, and it may literally be worthless. So I have faced the challenge of how do I mitigate my vulnerabilities? So when we're thinking about trust and trustworthiness, it's tied up with people dealing or lenders dealing with these two difficult elements: uncertainty about the future and dependence upon what someone else does. And so in thinking about how a credit economy has evolved, in some ways what I'm doing is tracking over time, starting in the early 19th century and going to the end of the 20th. How have people who participate in a credit economy, how have they dealt with those two problems? How have they tried to manage their vulnerabilities? How have they tried to gather information? And how are those problems solved? And that's where there's been a massive change, I would say, in American economic history. Early on, and I've sort of used you as an example, but that's sort of how everything worked. Back in the early 19th century, if I were, faced with the possibility of lending money to someone, I really would want to know what sort of a character that individual is. Do we have a direct social tie? Are we part of the same community? What's that person's reputation like? If we don't have a direct connection, like they're not my friend or my neighbor or my relative or something, maybe I know somebody who knows them. So maybe somebody can vouch for them, right? And that kind of informal way of evaluating people works great when you are all members of the same small community and these information-rich environments where there are lots of social ties, where people are part of the community long enough for everyone else to get to know them. It doesn't work so great when you're looking at credit on a national scale, where credit now goes across the continent, right? From New York to San Francisco. People don't know who each other is. There are no social ties. They're outside of the networks. They're a bunch of strangers, right? So what has happened is that system as a source for information, but also as a set of resources for mitigating vulnerability, that doesn't work at a big scale, at a national scale. So starting in the middle of the 19th century, we witnessed the emergence of new forms of information with credit ratings and then credit scorings. And this system enabled me as a lender, maybe based in New York, to get some useful information about somebody who was on the other side of the continent, in San Francisco, say, who wanted to borrow money from me or wanted to buy goods from me. And even though they were complete strangers to me, I'd never heard of them. I don't know anyone who knows them, just a total blank, but I could go and consult one of these credit ratings provided by mercantile agencies, and they would tell me, here's how trustworthy we deem this individual to be, and then I could make my decisions. And obviously, if they signaled this is a very creditworthy individual or firm, they have a really good track record, I would say to myself, all right, I'll take a chance. I may not know who they are, but I've gotten this powerful signal that they're trustworthy, and so I will lend money to them, or I will ship goods, and I'll be pretty sure that I'm going to get paid. And if they got a low score, then I would say, maybe I don't want to deal with these folks. They're not trustworthy enough. Or if I want to deal with them, I'm going to really charge a high interest rate. So I could calibrate the terms of the deal to reflect how trustworthy they were. So what I track in the book is basically the invention of these new ways to evaluate the trustworthiness of debtors and the ways in which these migrated from one context to another, because in their origins, they started in a very particular context, that of short-term trade credit, which is really the credit that goes between a supplier and a business customer. So that's a very particular context, but it turns out that the people who were doing that basically invented a way of thinking about creditworthiness that was really portable. And then it started to migrate into other contexts. And so that's what the book is about. It's watching how this moves from into other forms of credit out of the context of unsecured trade credit. And so I've got separate chapters on things like mortgages and bonds and sovereign debts and all that kind of stuff. Eventually, individual consumer credit. so we can kind of see this thing spreads. So there's like a lot of detail. There's a lot of things going on.
Yeah.
There's a lot of history being covered, but I'm trying to kind of pull it together by focusing on a couple of threads that are about that connect credit to trust, to trustworthiness, to information, to vulnerability and uncertainty, and so forth. So I hope it looks coherent, because I was trying hard to get that.
No. It definitely is coherent, and it's interesting to see how it kind of evolves, especially the historical piece. I guess the thing here is kind of going with the initial premise here, right, about trust and promise. And typically when people think about, there's a lot of other things here that are at play. And I can think of all of the various loans. I mean, I have student loans like a lot of people do. I have a mortgage, I have a car note, like, many things that people have. I'm not that special. I'm just like all, most other Americans. But there's this interesting way of we don't think about it in those ways. And I mean, obviously it is a contractual agreement or, financial agreement, but there are ways in which we don't kind of abstractly think about it. And it is one of those things where it's, in terms of the monetary piece, money really is something that, is showing a type of, security. Right. It's a type of security we have, right? It's how because it's, well, if you have money of sorts, you're able to have a certain way of living or to live in a modern society. You don't have money, you don't have that way of living, right? Or you'll have to be dependent on someone else, or et cetera. And so it has these things of security and trust and all these things, as some of the things you're mentioning, but also in terms of the wealth piece. Obviously, the major contributor of wealth for most Americans, and I think for other people around the world, is homes. Well, it used to be land, and like as your cattle or things like that, or certain types of domesticated animals, but now it's mostly homes. That's, obviously people have, stocks and things like that, but for the average American, it's the, main source of wealth is mortgages. And so again, but there's an element of that, which is also, look, I'm going to do a 30-year mortgage. Right. Well, this is an investment for myself, but we're talking, 30 years into the future, right? I mean, the only biggest thing I've done, in terms of long-term planning for my life is probably get married and have a kid, right? Those are the only other things that I do.
Those are big.
Right.
Those are big.
Those are big. But then right after that's probably a 30-year agreement I have for my mortgage. So that also has to deal, I think, also with status, right? Of like, there is a difference between, someone that does have wealth or doesn't. So all of these things come into play in really interesting ways. And I guess there's two pieces I want to ask about this, right? Kind of setting it up here is this has obviously exploded and expanded as population has grown, as we've moved from an agrarian society to an industrial to now probably a technical or digital age. There's all these different epochs of sorts. And we've become, in the United States, there are many wonderful things about capitalism, many, many good things. The fact of, all of the things that, I'm using and the tools and the technology of how we're having this conversation now is due in large part to some form of capitalism, right? Which is a good thing. I think there's a lot of good things to it, but there are perversions to it. And so now we have a system where there are really terrible ways in which people kind of get screwed over, and with all of these certain systems. So there's that, and kind of some of the inequalities there that can happen as well. Obviously income and wealth inequality. So I guess, how do we understand in terms of how we've the history of things and how these things have gone? There's a difference between, I'm going to make a promise with you, Bruce, that I'm going to give you the $1,000 and then it's $2,000 or whatever the analogy was in the beginning, but that's fundamentally different from the agreement I have with Department of Education or my old Freddie Mac loans or whatever. When we're talking about individuals having agreements with institutions or institutions with other institutions, that gets a little bit different. So I guess, how do we understand it within, you can just kind of give an overview of the history of that, but how we understand now with where, there are some pretty big downsides for people getting screwed over. So how do we understand that piece of it?
So I think a lot of what you were describing there captures, I think, people's ambivalence about debt. Like it's just not an unmitigated good and it's not an unmitigated bad. It's somewhere in the middle and it depends. So let's think about home ownership. That's a common aspiration. Lots of people think, it's part of the proverbial American dream to own your own home. It gives you status. You're a homeowner, and that's a valuable status. It means you're kind of solid, right? And it also gives you a place to settle down and to enjoy. You have a full place to raise your family and all the wonderful associations and activities that are tied with where you live. If that's a nice, comfortable place, you get neighbors, there's schools for your kids. Lots of our social life is wrapped up in home ownership.
Right.
And how do you normally become a homeowner? You go into debt. You go deep into debt. You sign that 30-year note. So all of that goodness is tied directly to a massive, biggest financial obligation of your life. I mean, speaking personally, I remember the first, when I bought my first house, I, of course, had to take out a mortgage because I couldn't put all cash down and so forth. And I remember looking at the amount of the mortgage and thinking, oh my gosh, this is the biggest number I've ever seen in front of me. And this is what I owe. It was terrifying. My hands were shaking. The bankers probably thought, this guy's going to lose it. He's sweating, but I just felt like this was such a massive obligation and it was going to encumber me for so many years because it was one of those long-term mortgages. So I think in a lot of ways, living in a modern credit economy means coming to terms with our very ambivalent feelings about debt, the way it's, it feels it is literally a burden. It is an obligation. Sometimes the numbers are very large. Sometimes it's for a very long time. So you really do feel like you're carrying a burden around. But it is in many ways how it's the secret to living our lives. It's the secret to, it's how you get to home ownership. And so if you're thinking of a kind of a wealth strategy for a family, you, as you pointed out, for a lot of average Americans, the single biggest asset that they have is their family home. But almost always tied to that asset is a big obligation called their mortgage. So it's not always going to be a plus. It's a plus with a big minus attached to it. And, your ability to have a car, to be mobile, to drive to work and so forth, you got to have a car. Most people, take out a car loan that's, going to finance a lot of the value, a lot of the purchase price. People who get educated, oftentimes they have to go into debt. So if you think about a lot of the good things that we enjoy as a household, as consumers, as homeowners, it's always inextricably tied to some kind of obligation. And so we have very mixed feelings about debts. And surviving is really a matter of managing this balancing act. Surviving as a household means making sure your income is coming in so that you can service your debts, making sure you aren't overwhelmed by your debts, dealing with unexpected interruptions to your income. People that lose their jobs, or the boss says, I can't give you 40 hours next week. I can only give you 20, and so their income drops. Those are people who are, who often are thinking, how am I going to service my debts if I have them? But if I don't have them, going into debt is a great way to kind of paper over the fluctuations in your income. So that's one way in which you can get by. This is, again, why debt can be so useful. It not only allows you to buy a big asset like a family home, but it's also a way to kind of keep your household running, because we saw this through the recent pandemic. A lot of people, credit card balances went up because a lot of people who, suddenly lost their job in the service sector, like they worked in a bar or a restaurant, we know when the pandemic began, that whole sector closed down. Right. All those people were suddenly out of work. And what are they doing? What are they living off of? I'll bet a lot of them were living off their credit cards, which was short-term debt. And that's what kept them going. And eventually, they had to repay those debts. They, racked it up, a big credit card balance. And so they were able to recover. But thanks to debt, they were able to manage to survive as a household, even though their income had, declined suddenly and maybe even catastrophically. So, yeah, going into debt is a bad thing. But in a lot of situations, we're doing it for a very good purpose. We're doing it because it lets us do something. It lets us to survive. It lets us get educated. It lets us enjoy home ownership. So, right along, in every aspect of life, we are engaged in managing our indebtedness. And, one thing that you mentioned in your question was, does it make a difference whether I owe my debt to another individual that I know or that I owe it to an institution, right? And legally, it doesn't, because legally, if you're a debtor, you owe somebody some money, right? That's just the cut and dried part of it. And actually, now typically when we have a mortgage, it's to an institution, to some lending institution. If you go back 200 years, you are almost certainly owing money, even in a mortgage, to another individual. Like the people that were doing mortgage lending in the early part of the 19th century, it wasn't, banks and savings and loans and, the kind of institutions that populate the landscape now. In those days, it was very much individuals. So you really did, even for a mortgage, you really did owe it to a particular individual. And one of the things that makes that kind of setting interesting is that sociologically it operates differently for, I think, exactly the sort of reasons that you intimated. A particular person, if, like, for example, if you owed me money and then, you said, Bruce, I'm having a hard time. Can you give me a couple of extra weeks or months or whatnot on the debt? If we have a personal relationship, you may owe me, but I may feel obliged to cut you a little slack, and we can negotiate and we can make adjustments informally. And that's what you often find in informal debt networks, that they can be stretched and accommodated and rolled over, and people's relationships can impart a certain kind of flexibility to them. Whereas if you're dealing with a completely faceless institution, and good luck, you go onto their 1-800 number and you'll be on hold for 10 years, and you'll probably never talk to an actual human being. You'll just get lost in a phone tree.
Yes.
And so good luck negotiating on that. And probably your mortgage has been securitized, so the party that you were dealing with originally when you borrowed the money and signed the contract, they don't even hold the note anymore. It's been chopped and sliced and diced and securitized. So you may not even be talking to the right people. Right. So the fact that it's become more institutional certainly makes a difference. But I think what hasn't changed is the fact that we feel really mixed about debts. There's an upside, there's a downside. Surviving means, making sure that the downside doesn't eat you up, and making it possible for you to and your families to enjoy the upside of debt.
Well, I think the part of the reason is because we have less control over it, right? I mean, there's definitely less perceived control over it, right? People talk about good debt and kind of bad debt, right? So it's not a great thing to rack up credit card debt and high interest rates and all these things. Although there are moments where, look, I mean, such as the example you gave, obviously some people did that in 2008, 2009. But, there's these instances where it's, I can hear some folks that I know, they'll be like, well, I just don't want to play in that system. I just don't want to play in the whole system. I just want to, put my money in the cookie jar or under the mattress, and I don't need to put it in a bank, and I'm just going to pay everything in cash. And the reality is that that's, again, there's pros and cons to it, but that's the way the world is. And I think part of that is, you obviously have globalization, you have things that, the world is super interconnected, but also in terms of how you amass more wealth, or, and then also what that looks like in a society or in the United States, a country that went, growing, very, very small in terms of population and interconnectedness, all the way up until 1900. And then every 10 years in the 20th century and now in the 21st century, it's just millions more people every year. Progressively, you have to find ways of scaling upwards of how to have this types of flow of things. So kind of to that point, you talk about this in different places in the book. So I want to kind of big theme here that I want to land on for a bit is you talk about credit rating agencies, right? And this was super fascinating because I didn't know any of this stuff, right? I just know I need a credit score over a certain number, and it's been 0 when I had no credit starting out, and then I built it up, and then it went bad, really terrible, and then my credit score I think is pretty good last time I checked, so that's nice, but there's a whole lot to that, and I mean, people that live in the United States or other places will know that. I mean, that's really, that can be super important to renting an apartment. That can be important for how do you get a car, obviously a house. Like this isn't just, if your credit score is under 600, yikes, you're going to have a tough time playing around in the world. And, some people will, kind of bristle at that and be like, get angry at the system or institutions or whatever. And that's fair. I can hear some of that. But there's this whole thing we've developed. And so you kind of touched on it earlier. So kind of give us the full thing here of how we got to developing credit agencies, why they're important, and kind of where they're at now and how they function.
So I'm going to be really stylized and simplistic. And so, in the book, there's a lot more nuance. So please don't, think I'm a complete idiot. But to cut to the chase, evaluating somebody's creditworthiness in the olden days, going back, was very much this kind of qualitative judgment. You knew a person, you knew their bona fides, you knew who they, hung with, you had a sense of their social connectedness to others. You had social connections to them. All of that massive information that comes from direct knowledge, hearsay, gossip, reputation, all of that was kind of brought together in a judgment about how creditworthy someone would be. And now we operate in a world where most of the people who extend credit to us, they have no idea who we are. They have zero personal knowledge of us, of our history, of our family, of how we keep our word? Are we a stand-up person? All that kind of stuff. But they do know this number, and the FICO score is kind of the most famous version of that. And you are absolutely right. It is very consequential. If your FICO score is high, the world loves you and wants to give you credit. And if your FICO score is low, good luck with that.
That's going to be a tough time.
Trouble.
It's going to be a tough time.
As you know, people now are busy trying to think, okay, I got to manage my score. How do I boost my score, right? They're thinking very strategically about this number because they know what matters for them.
How can I boost it fast enough? 6 months is too slow. I need this now.
Exactly. And that, it turns into money right away. It's going to cost you if you'll get a better deal. So that's the world that we operate in now. And the thing that is really maybe a little scary about these FICO scores, they were invented to deal with credit. But now they're being used in lots of other venues, kind of so-called off-label use. So now, if a landlord, if you want to rent an apartment, a landlord is very likely to consult your FICO score. And it's not, the landlord isn't going to lend you money. It's not like you're taking out a loan from your landlord, but they're using this as a kind of a rough and ready measure of how trustworthy you are. Are you going to pay your bills? Are you going to be well-behaved? Are you going to set fires to my apartment, if I'm the landlord, right? So they're using it. So now it's suddenly affecting your access to housing. Employers are consulting these things about who to hire, right? Again, it's not that your employer is going to be lending your money. They're not a bank necessarily, but they're wondering, should I hire this person? And are they going to be a good worker? So they're using it as a kind of a rough measure. I know online dating apps, a FICO score is now a thing like, are you going to get a date now? You are, you're much sexier if you've got a high FICO score. Everyone loves you. So So
well, it's going to show this person's stable, right? They have some way to access in the world. They're not going to be just, in between jobs or, something where they don't have some type of stability. So if you're a potential mating partner, like, is this person got the shit together? Are they a stable person, right?
Totally. Yeah. No, I mean, there's a reason for why but that's not what it was invented for.
Right.
It wasn't invented for matchmaking. And partly because it's a nice summary number that's readily available and can get plugged into lots of different contexts. The uptake on this has been really impressive, which means that as a society, if these numbers are becoming so fateful, and if somebody's well-being in so many different contexts is now dependent upon that score, we probably should spend a little more time thinking, where did these scores come from? What purpose do they serve? Are they necessarily the best thing when we repurpose them? Should we maybe be thinking of another number? And this is an important one. What is the obligation of the party that creates the number to get it right? Because now people's lives are at stake, not just their ability to get credit, but to have jobs, to live, to get insurance, to get a date, for goodness sakes. Right. All of this suddenly is resting on these numbers. And, the regulatory apparatus that oversees credit scoring is it's old. It hasn't been adapted for the new world that we live in now, where all these alternative usages are very commonplace. And the obligation of the credit agency to correct mistakes, to let people know what their scores are, to temper the usage of them so that they aren't used in inappropriate contexts. All of this is kind of pretty vague and maybe a little antiquated. So I think you put your finger on a really important change that has happened. These numbers have become super important for the everyday lives of ordinary Americans. Let's look over them and let's think about whether we like this system rather than just letting it run willy-nilly. The other thing that's going on now, and again, this is a very contemporary change, is that the people, the credit scoring has been around. FICO scores have been around since the 1950s. And they're very important for credit cards and all kinds of stuff. Mm-hmm. But it's pretty familiar to us. And now we're in a world where a lot of our social and economic activity is happening online.
Yeah.
So now you shop online, you socialize online, you like things online, you watch things online, and all of this data, online data, which is both social and economic, is being harvested. And so there's some companies who are starting to realize, if we augment the traditional credit score, which is calculated, the credit rating agencies, they get a bunch of data about your employment and did you bounce any checks and, all of that economic stuff, and they turn it into a score. But now there's a whole new set of data that is being generated through social media and online commerce, e-commerce and whatnot. And some companies, fintech companies, are starting to think and to propose, we can get extra leverage out of this new online data, and we can augment the traditional credit score. And to kind of justify this, oftentimes they talk about democratizing credit or democratizing finance. And the idea is that there are some populations who, by the traditional criteria of credit scoring, were denied credit. Or when they did obtain credit, it was at a very expensive price. And so fintech companies are starting to say, gee, if we use the data that we have access to now, all of this online stuff, clicks and likes and tweets and blah blah blah, all that stuff, we can identify people who are truly creditworthy, but who by the old criteria maybe didn't look so good. And now suddenly those people can get access to credit. And isn't that a good thing? Right? But again, as we know, what's going on in the world of big tech is a big fight over privacy rules, over data ownership, over the, all the obligations that are coming. So, issues of antitrust, and so there's going to be a regulatory conversation about how those new data sources may change the world of credit. Because a lot of people might think, my Facebook friends shouldn't have an influence on my credit score. Why is it? Why is that starting to happen? Who my friends are on Facebook, just to take an example. But there could be that, depending upon who your friends are, maybe someone gets a little statistical leverage if they're trying to predict whether you repay your debts. And so the question is, do we want our social lives mediated through social media to affect our economic lives that are governed by our credit scores? So there's lots of questions, lots of things that have come up very recently that I think mean that it's really incumbent upon us to think, how is this information that guides credit decisions? How is it being generated? Who owns it? Who controls it? What are their obligations? And is it being put to proper use?
Yeah, I mean, I think that there's this piece of it that is, like you said, there's somewhat of an antiquated system, or it's a system like many things that just hasn't been updated, which is fine in one sense. Like, okay, sometimes it takes time. It's a big system that's been there. Obviously, the idea of it is good. But when it now, as you're saying, has these kind of off-brand, kind of ways of doing things, then it's like, okay, now it's not just, what's my FICO score to get a credit card? Now it's, when it has so much impact on just your livelihood, there is an impetus to say, we need to, update this and to make sure that we're keeping it current and modern. But again, that problem you're listing off there is one that continues to be a debate about, big tech and privacy and regulatory things, and it's no one has everyone's pointing to the same problem, but no one has the Rosetta Stone or whatever to figuring out what is the way in which we solve it, which is going to be interesting to see for something so consequential. I mean, again, right? It's if you take the kind of futurist kind of model, I mean, we're literally assigning status numbers of sorts, right? And it's like, okay, there's some really icky implications for that if the wrong person is managing that or reforming that, and we're in these types of ways where we're siphoning each other off based on our status score. That you can definitely see the potential for some pretty bad faith actors to use this not so well. But but then again, you can use it for also very positive and very, very helpful things as we're moving into a very fast, growing future. So there's, you can see both sides of this.
Yep. I mean, I think one thing that has characterized American society in its sort of economic dealings is the idea of a fresh start. Like if things don't work out, the land of opportunity is a place where you can get a fresh start. You can start over. You're not doomed for your entire life, right? And one of the ways you could have had a fresh start, but which is becoming increasingly difficult, I think, is let's say you didn't pay some debts, and so your FICO score tanked. In a world where your FICO score is now going to govern your access to housing and employment, it may be really hard to recover from that blow. Situation now is not a thing you can dig yourself out, because now suddenly it's a struggle to find a place to live. Now suddenly it's a struggle to find a job, to take care of yourself. And again, it's a struggle even to get a date. So you're all on your own in this world of where FICO scores matter so much and yours is a low one. But in a world where these things were not all interlinked, where employment and insurance and housing and social life, where these things were not articulated, they weren't all tied together, you could screw up on your FICO score because you bounced a few checks, you didn't pay some bills, but you could still get a job. And if you could get a job, you could repay those bills, or you could establish a good record. You had a chance at a fresh start, right? In a world where the same numbers are following you around, basically, I mean, if they are good numbers, the world's your oyster.
Fantastic.
That's
Right.
But if they're bad numbers, it's going to be a little harder for you to reboot your life and get that fresh start, precisely because these things keep following you around. Your bad credit record becomes like the millstone around your neck. And I think that possibility of a fresh start is something that has really, animated a lot of how Americans think about economic opportunity. It's like you're not doomed forever. The situation is never hopeless. There's always a chance you can turn things around. People like that idea. It just means you're not doomed forever if things didn't work out at the beginning. You got a fresh start. So I think that's one of the ways in which, some basic American social values are being challenged when this whole thing becomes completely monolithic and the numbers that are calculated just determine everything.
Yeah. No, I firmly agree with you on that. I mean, that's, that's a really tricky thing where we're at. And again, I don't think there's, Oz behind the curtain pulling the strings here. I think it's just something that has just evolved. And, if there's no regulatory, checks and balances, it's just going to evolve in ways that aren't always the best. So yeah, I firmly agree with you on that. Okay, two big topics, just briefly. I want to talk to you about, obviously, I think you mentioned in the beginning of the book, there's been other, books written on this and histories and things like that, but it is something that comes up often. And I guess just from your kind of lens, from what you're looking at in the book, is this idea of the central bank in the United States. Now, again, I totally understand that you're not an economist or historian in that sense, but you do mention it in the book. And I feel like, so let me just current to them backwards. So currently we don't have a central bank in name, but the Federal Reserve is essentially our central bank of the United States, which was created in 1913 under President Wilson, I believe. And up until then, we had not had a central bank or central bank-esque for almost 100 years. I think it's about 80 some years. So what some people may not know is that the Federal Reserve is, again, it's not technically, but it basically functions that way. We had our first bank from 1791 to 1811, dissolved second national bank or central bank from 1817 to 1836, and then that was done away with by Jackson, if I'm not mistaken. And then for a long period of time, most of the 19th century, we did not have a central bank. And so, Wilson, obviously there was big problems. You had the crisis of somewhere in the 80s or 1880s or 90s, and then there was all these other crises that were happening. And anyways, the point is that we have a central bank now. We have had one for over 100 years in the Federal Reserve, but a lot of people kind of moan and groan about ending the Fed and, why would we have this and why do we not have just privatized things and things like that? So, what is, I guess, this kind of, you give the history, but what is this case when we're talking about big scale? And again, the United States is the third most populous country. It's one of the biggest countries. To not have a central bank seems ludicrous in my mind. But how do we understand the necessity or the need given our history and where things are for us economically?
So one of the things that the American experience has proven to us is that financial markets are prone to instability. They go up, they go down. There's credit booms, credit busts, banks fail. Everyone's lined up. You get the scene from It's a Wonderful Life where everyone is, showing up to Jimmy Stewart's bank and they want the money out of the bank. And so there's a bank run, right? But that kind of stuff was going on throughout the 19th century. And so one of the reasons why this country established the Federal Reserve, and you're right, it is the central bank for the United States, was recognition of the fact that there's a public interest, there's a national interest in the stability of financial markets. And financial markets where all these credit things are going on, right? So it turns out they are prone to instability. And so what the U.S. government wanted was an instrument, a policy instrument, an organization whose job it was to help impart stability to these otherwise incredibly unstable financial markets. So in the short run, there was a financial crisis in 1907, right? And, J.P. Morgan had to come to the rescue, right? You don't want to have a country where everything depends on one guy, to play the role of Superman. That's just not a stable situation. And so that kind of really, and that against the backdrop of lots of other financial crises in earlier periods in the 1890s and before that, this sort of accumulated, and people thought, geez, we really need some way to kind of deal with financial crises. And so they established the Fed, and it took a while, because from 1907 to 1913 means they didn't solve it right away, and there were commissions, and they studied, and there was some politicking and so forth. But basically, the Fed was intended to kind of help deal with financial crises. And since it came into existence, there was the Fed has learned how to refine its craft. So the Fed now, as you know, it's responsible for price stability. It worries about the value of the dollar, and so our interest rates are going up because we are dealing with inflation. It also worries about economic growth, so it's always having to balance off these two things. But right now, today, the priority is price stability. But definitely, the Fed was put in place to deal with the problem that financial markets have a lot of instability. And the American people, through their government, through their federal government, want some kind of agency or organizational vehicle to do something and to deal with these crises, to prevent them, to forestall them, and so forth. And so, of course, we had the Great Depression, massive bank failures, lots and lots of bank runs, lots of financial instability. The mission of the Fed was sort of redefined and re-understood, and there was a new agency created for deposit insurance. And so we had the invention of FDIC, and we had lots of New Deal financial regulations put in place, all part of, the separation of investment banking and commercial banking, right? A lot of regulatory activity that, again, spoke to the issue of, gee, our financial sector is really unstable. How do we stabilize them? And so after the New Deal, post-World War II, there was a long period of time where there were almost no bank failures. After rocketing up in the 1930s, where they were just dying left, right, and center, they really stabilized. And then at the end of the 20th century, we have a push for deregulation associated with what some people call neoliberalism, kind of a belief that regulation is bad, that too much regulation will throttle markets, that we want to deregulate, we want to liberalize. And so that apparatus that had been stabilizing things was slowly taken down, and we had financial deregulation. And what did we get? Pretty soon we had another big financial crisis, the global financial crisis, so on an even bigger scale. And so in the wake of that, there was again a kind of a realization that, finance, left to its own devices, finance produces a lot of instability, and it's not good for the country for these things to just tank all of a sudden. You just think, you're old enough to remember what was happening in 2008. Lehman Brothers failed. People were running around like chickens without heads. Like no one knew the sky was falling, right? It was a bad thing. It was not good. And it was global. By that point, it wasn't just an American problem. It was a global problem. So the kind of Fed, did all kinds of things. Quantitative easing, they were working really hard to try to stabilize things. But again, it reflects the fact that, we have a central bank because we, like every other advanced high-income country, we have an interest in the stability of financial markets, and we need an instrument. That stability can't be assumed. It can't be taken for granted. We need someone in there with a bit of oversight, with the power to intervene, the power to make sure that banks aren't misbehaving, that they aren't doing funky speculative stuff that's too crazy. And so we created it. And it's kind of, our understanding of its mission has evolved because the Fed today doesn't operate like the Fed did in 1913. They had a very simple policy instrument. They had one thing called the discount rate that was going to be how they stabilized things. And now it has a much broader sense of powers. It has a much broader amount of information, but it's still at bottom is there because we have a public interest in the stability of these financial and credit markets.
Yeah, no, I appreciate you explaining that, because I feel like many people, they don't fully get that. And it's really not until you understand the kind of more recent, obviously, history for us, why, when left to its own devices, these financial markets, there will be crises, there will be problems. And there's just always needing to have this type of stress test for our financial system in our economics. And so, I think certain regulatory bodies are really important to try and, again, when you have a country, and maybe if you have a country that's, 5 million people or something, okay, maybe that's less important, or, you could play around with it a little bit, but you have a country that's 330 million plus people, big quote unquote superpower, et cetera. You need some of that. The last question here, because I want to respect your time, is just briefly, you mentioned student loans. Obviously, it was in the news, student loan forgiveness, and people were saying that, Biden's choice to do this was terrible. It added to the national debt. Oh my goodness. And then other people were saying that he didn't go big enough, and why didn't he just forgive all of it? And so, I'm an older person of sorts to remember I had some old Bush era student loans I took out, right, that were privatized.
You're dating yourself.
I'm definitely dating myself. And then I had for my doctorate, I had the when Obama switched it to Department of Education, and so there are obviously pros and cons. Most of it is the interest rates on some versus others. So there's been a weird kind of history with this kind of stuff, more recent in the past 20 years of sorts. So again, people, good debt, student loans, okay, but it is, what was it? It's an old number now, but there's something in the ballpark of 60 billion every year the U.S. government gets from interest rates from student loans, which is insane, because I'm paying every month, many people are, and my number doesn't go down, right? It's like when I owe somebody, $5,000 and I pay $400 every month, it should come down to $4,600, whatever it is. That doesn't happen. And sometimes it goes up, right? Because it's just the interest rate or whatever. So I guess you talk about it obviously in the book, but in terms of student loans, this is becoming a bigger issue. It's ballooning, So what are some of just your brief thoughts on student loans and how this impacts the idea of trust, promises we make, how we should honor them, or et cetera?
Yep. So the short answer is student loans are how Americans have decided, without really an explicit conversation about it, but this is how we've decided to finance a lot of higher education. We could fund, colleges and universities and community colleges and technical schools. We could just fund them, cover their budgets with allocations of tax dollars. But what you see, the trend in higher education has been very much that the public support has been shrinking, and so schools are more tuition dependent. Yeah. So I think at this point, even if you look at the flagship public schools, like University of Michigan, right, is called the University of Michigan, and yet the amount of its budget that comes from the state of Michigan, it's, I think, under 10% of its budget, right? Yeah. So the university has to get money from somewhere else. And one of those sources, obviously, are the people who are getting educated, the students. Mm-hmm. And so, and students, are making an investment in themselves. Mm-hmm. So you could tell a really plausible story about how, you go to college, you get a college degree, and your ability to get high-paid, good jobs in the labor market goes way up with a college degree. And there's a lot of truth to that. There's a lot of variation because it depends on what you major in and where you go to school and so forth. But just as a kind of a simple summary fact, it's a good deal. It's a good deal for people to go to college. Their future earnings are going to be higher. And but what debt means is that somebody can afford that higher tuition by borrowing against their future earnings. Mm-hmm. That is to say, they, if you're an 18-year-old, it's not like you have a lot of money or high income. You're making a bet on your own future. because someone has to pay for your education, and it turns out it's going to be you and your family and, the financial aid and so forth. But a big part of it is going to fall on the student now. And the idea there was states are not that interested in funding higher education, not like they used to.
Mm-hmm.
So the money is going to come from, a lot of it's going to come from tuition. And who's going to pay that tuition? It's going to be the student. But the student is a unemployed 18-year-old, right? So they don't have a lot of income to pay that tuition directly. They're going to borrow the money, but they're not a very good credit risk. So what the U.S. government did was set up these loan guarantee programs where, if you take out a student loan, the federal government encouraged a bank to lend to an otherwise not very credit-worthy individual, someone who's just starting out, doesn't know what they're doing,
right.
Doesn't have a lot of skills, but the future holds promise.
Mm-hmm.
And by backstopping those loans, the federal government encouraged banks and other lenders to lend money to students so that they could pay their tuition. And so now, and this system kind of worked, well, in the sense that people could get the loans because they appeared to be more trustworthy because there were these loan guarantees. The schools got the tuition dollars so they could continue to operate. The federal government, kind of backstopped it all. And this thing turned into a juggernaut because it made it possible for, departments of education in various states not to have to directly fund higher education, even though we know it's socially beneficial. And so the direct tax dollars have been shrinking. The dollars that come in the form of debt have been growing. And now, we have a crisis because we have people who are graduating with these massive debts.
Oh, yeah.
And they're in a hole and they're not digging themselves out. So it's not like a mortgage loan that is self-amortizing. And, if you get the 30-year mortgage, after 30 years, you're done, you're free. Mm-hmm. Like it's all paid off, including, interest and principal.
Right.
And you just kind of described the situation where the principal keeps on growing and all you're doing is paying the interest. And it's like you're feeding a beast that keeps getting larger and larger, and there seems to be no way out.
The analogy I use is it feels like I take a big wad of $100 bills every month and I just throw it into the wind and it just goes away. That's what it feels like.
Mm-hmm. That's probably not a very good feeling. Yeah.
It's not the best feeling, but yeah, it is obviously a big problem. And, I think that forgiveness is fine, but I think that there has to be, there's so many other issues within the system at the beginning, throughout, afterwards that need a whole full reform, which, I just don't know. It feels like one of those problems where, we'll probably deal with it as a country when, the house is on fire right. Instead of a little bit more proactively.
Right. Well, I think if I can just pull I think the student debt issue, it is a problem, but it's really a symptom of a kind of a broader, more complicated set of interconnections for how much this country wants to have an educated workforce, have an educated citizenry, and how much money are we willing to put in directly, publicly, so that works. And so you have all these fights about public versus private education and secular versus religious. Yep. And, so there's a whole can of worms. And basically what we're seeing is one symptom of this giant festering can.
Yep.
And it's blowing up in our faces. But really, if we really wanted to come to grips with it, we'd probably have to open the can and really deal with the worms. And most politicians don't want to do that. That's really tough stuff.
That's not going to get you reelected if you do that. It does really remind me of there's some similarities with this whole thing of what we were trying for 120 years to do healthcare. And we did something. We did something that was good, net positive, but, imperfect, incomplete. Mm-hmm. Yep. And it's the same thing. We need to re-update our immigration system, terribly so. Tax reform. There's so many things, and so it just becomes kind of a bigger beast that no one wants to really open that can of worms. I guess real quick, my last question. I ask this sometimes to people when they write, spend all this time, 2, 3 or longer years writing a book. If there was the one thing, someone reads your book, what is the one thing you hope they walk away with, where you can say, yes, you got it. That's exactly what I was trying to say. You got what I was trying to say. What is that one or two or whatever things that you want people to kind of take away from your book?
I want them to appreciate. So we've been talking about politics, and and politics is tough because you're dealing with tough problems, but it's also tough because partisanship is so intense right now.
Yeah.
And so one of the things that I want people to appreciate is that even though kind of what's in front of our face is this intense partisanship where Democrats don't trust Republicans and people don't trust, social institutions, and the right wing of the Republican Party doesn't trust the centrists, and everyone seems to distrust everyone else. And so you might think, we're going to disappear into chaos, and how can a society survive when no one trusts anyone else, right? Mm-hmm. What I hope somebody would appreciate is that while all this stuff is happening and blowing up and attracting so much attention, there is this system that has been operating for a long time that helps put food on the table, that enables our consumer economy to function, and it is all around the determination of who is trustworthy and who is not. And it definitely has problems. It doesn't work perfectly, but it is not at all afflicted by the kind of sharp cleavages that you get in politics. It operates. And so it turns out that Republicans and Democrats alike can get credit cards. Republicans and Democrats alike are borrowing money to buy houses. So all of that stuff is operating very effectively in the background. And so I hope that, people will appreciate that our society isn't being ripped apart in this apocalypse of distrust. Mm-hmm. There's some of that stuff that's happening, for sure. I don't want to downplay it. Mm-hmm. But there's a lot of other places where we have something that functions imperfectly, but well enough. And our economy, which is still the biggest one in the world, it's still bigger than the Chinese economy. It absolutely depends on the fact that we're able to make these determinations about who's trustworthy and who isn't. And we do so in a way that more or less works and goes from the scale of big corporations all the way down to individual debtors. Mm-hmm. And it's been doing that for a very long time. And so maybe we can kind of think about trusts and distrust in less dramatic and apocalyptic terms. And maybe there's something we could learn there. Who knows?
Yeah. No, I couldn't agree with you more. It's fantastic. The book is called The Economy of Promises, Trust, Power, and Credit in America. I believe it is out everywhere, correct? It is out everywhere?
I'm sure it's in every bookstore. That's what I'm hoping. That's my fantasy.
Well, it's through Princeton University Press. Where can people find you, find your work, or find best places to get at you?
I can be Googled. You just type in my name, and you'll be directed to my Northwestern website, where there's lots of information about me. But you'll also easily find information about the book. Mm-hmm. And how you could purchase it if you're interested, in various activities that I have. There are talks that I've given on this that are available online and YouTube and various other things. And hopefully they'll be able to find this conversation that we're having today before long.
Absolutely.
Yeah.
Well, look, Bruce, it was an absolute delight. I think this is an important topic. It's something that doesn't get. It's definitely not sexy, but it is something that people will go back to if there's another recession or something. Like, oh wait, how do I understand all this again? And so you have done a great service writing a book like this, where everything's kind of in one place and pretty understandable. And so I think a lot of people will get a lot out of it. So I can't say enough thanks for you coming on and talking about it, and for all the work and research you're doing.
Well, thank you very much. And it's been great fun talking to you.
All right. Likewise. Thank you.